Over the last 20 years or so of being a CPA, I've talked way more people out of being an S Corp than those I've talked into becoming an S Corp. The reason is that without proper tax entity structuring and entity planning, any tax savings won't matter. You won't be able to make the right tax elections. You won't be able to aggregate these losses and income to offset and become tax efficient. So many of these moves are dependent on the types of entities you have. Today, we're going to talk about my go-to structure for a growing, scaling, asset-heavy business. Before we do that, quick identification. My name is Roger Ledbetter. I'm a CPA in Texas for just under 20 years or so. I work a lot with pass-through businesses, partnerships, S-corps, and their owners, and filing their tax returns and doing really solid tax planning for them. I have this conversation a lot, and I draw this picture a lot. And this picture that is my kind of my ideal or go-to structure is really uses the three types of ways that an LLC can be taxed for federal tax purposes without a C Corp, right? And so if you remember your kind of tax 101, an LLC is a state designation, right? This is the type of entity you are at a state level. You can be a Texas LLC, a Florida LLC, but the government doesn't know what you want to be for federal tax purposes. So they give you flexibility. We have to file additional forms to tell the IRS what form we're going to be filing for the US side, for the IRS side, the federal side. An LLC can be a disregarded entity, meaning it does not file a separate tax return. A disregarded entity is usually a 100% owned LLC, and that will go on the owner. So if an individual owns 100% of an LLC, it could be filed on their 1040. If a C Corp owns 100% of an LLC, it will get filed on that C Corp's return, right? So a disregarded entity is the first type of LLC type that you can be for the IRS. The second type is a partnership, right? So an LLC can make an election to be a partnership or can actually get defaulted into it if it's a multi-member LLC. The third and last pass-through type of entity an LLC can be is an S Corp. So additional elections need to be made to make it an LLC as an S Corp. Now, an LLC can also be a C Corp. We don't really care about that. We're not talking about C Corps today. I want to spend time and talk about how we use each type of these three LLC designations for the IRS to kind of make the perfect trifecta of LLCs for a growing, scaling, asset-heavy business. So the first place I'm going to start is a partnership. And where do we want a partnership in our organizational structure? So if I'm planning out and I'm sitting down and having a meeting with a business owner or someone who's going to buy a business, one of the first things I do is look at the balance sheet. I want to know what types of assets and liabilities this business has, right? I care about how much money they're going to make. We're going to get into that. But you have to start with the balance sheet. I want to know, is this a rental property, right? Do we have heavy equipment that we're going to be taking depreciation on, right? Do you have inventory? Do you have AR? How big? So getting a vibe on the balance sheet is really important to understand what types of entity those assets should be in. Typically, we want heavy CapEx, heavy like real estate. We want these assets in a partnership for a couple of different reasons. A partnership is far more flexible for a lot of different income allocation purposes, the types of partners and owners you can have in it, right? So if you're going to raise money, an S Corp is limited on what money you can raise from these people. A partnership, again, LLC tax as a partnership, is less restrictive on who can invest in this business. The other thing is basis. We want basis in our assets and our liabilities, right? So when you contribute money into an S Corp, you have basis in that money you contributed. When you contribute money into a partnership, you have basis in that money you contributed. That basis means two things. You can take losses using that basis to use against other income. You can also take distributions against that basis, right? You can take cash out without being taxed on it. Where the partnership and S Corp differ is something called debt basis, right? So partnerships will give partners or owners of that partnership debt basis, meaning they may be eligible to take losses against that debt basis. Additionally, they may be able to take distributions using that debt as basis without being subject to taxes, right? S corps don't have that same flexibility. S corps do not have traditional debt bases in the way that a partnership does. And so we look at partnerships in a way that we want to put assets here, appreciating assets. We want to put debt in partnerships. We also want to put entities and partnerships that will have outside investors. For example, if you want to go institutional investors, you want to go foreign nationals, you want to go other companies like a fund to fund, right? You want to put other types of outside investors that aren't just people and individuals. You want to put those in a partnership. Now, we then move on to our second issue, which is income streams, right? So once we know the balance sheet and once we know kind of how we want the balance sheet and where we want those assets and liabilities, which will usually be in a partnership, we look at how the owner is going to get paid, right? How is this business going to generate income? Now, partnerships are great for all the reasons we just talked about, but they're not great for purposes of limiting what's called a self-employment tax and not great for optimizing the qualified business income deduction. And let me talk about this. If a partnership generates $1 million of taxable income, and say that is going to its owner, to one of the owners, the general partner, or in real estate would be like the syndicator, right? The operator who also owns a portion of the partnership. If that $1 million is going to that owner directly from the partnership, and that owner is involved with managing that and getting that K1, it is subject to 2 layers of tax. The first layer is going to be your ordinary income tax. Everyone pays this. This is just what everybody, this is on your W-2, this is what I pay. Anyone pays ordinary income tax. The second layer in the partnership that a partnership does not cut off is self-employment tax. This is 15.3% up to $167,000, I think it is now, and up, and then 4% over $200,000. There's like a 3% between 167 and 200, and then 4% above that, 3.8. That's a lot of money, right? When you get to 167 grand, 15.3%, do the math, is whatever, $20,000, $25,000 that you're going to save on the 160, or you wouldn't save on it. You're getting charged on that. And then everything above that goes forever, right? So up to $1 million at that 4% is another 30 grand, right? And so we're not getting rid of all of that. You have to set a reasonable salary out of the S Corp, but the S Corp helps you mitigate a lot of that unbridled profit that otherwise the partnership wouldn't mitigate, right? So this is the oldest benefit of an S Corp. This is used to be the old kind of singular reason that we would have S Corps and use S Corp salary to mitigate that. The other thing that happened in 2017 was now this qualified business income deduction. This same $1 million is eligible for a $200,000 deduction just because it's income coming through a pass-through business. Just because it's income coming through a K1, it is likely eligible for a 20% deduction before income tax gets paid on it. This reduces your top rate for a business owner from 37% to something like 29%. It is a massive tax savings opportunity. Partnerships, however, do not allow you to pay yourself a W-2 as an owner, which is one of the ways in which you can increase the amount of qualified business income deduction you're eligible for. S Corps do. With an S Corp, you can increase your salary, pay yourself a more reasonable salary, a higher wage, and actually increase your tax deduction. So you'll pay a little bit more on self-employment tax or FICA, but you'll get a bigger deduction. It will outpace the self-employment tax over certain amounts. And so we use S Corps, we would call them like management companies, right? So everyone talks about how you've heard about a management company or a holding company. This is just strictly an operational management company. What we're doing with management companies is having the partnership pay fees to the management company for services rendered. This is really great when you have multiple operating businesses, right? So when you start to grow your holding company, right, there's usually one management company for all these operating businesses, and they pay fees here to create, there's self-employment activity happening in this S Corp, But now all the management and all the self-employment activities being done in this management company, right? And so we try to direct these fees to an S corp, right? So we let the partnership generate income. We have the active income and fee structure going to S corps to increase qualified business income deduction and to limit the self-employment tax. Now, don't go and do this without talking to your attorney, without talking to your CPA. You need a management agreement. You need a legitimate company set up, right? You have to abide by the rules to get this benefit. So this isn't just everyone and their mother should have an S corp as a management company. But a lot of the times it can really increase tax savings when you structure it and you pay attention to what are the streams of income, and to the streams of income you can isolate from the operating business and how the operator is going to make money, the general partner is going to make money. An S corp would make sense, right? Now, this way, between the partnership, we get an increase in debt basis, we get flexibility in equity raising, right? We get much more flexibility in what we want to do with those assets. With the S corp now, we have also now kind of bifurcated that from the operating business, and this is where we get self-employment tax savings, qualified business income deductions. Now there's a third piece, right? So we've covered two of the LLC pass-through options, S corp and partnership. Now where does the disregarded entity come in? And usually this is at the top. And so when I'm drawing this out, at the top of this pyramid is the operator, is the general partner in real estate deals, right? And so many times this person, this operator, will also be required to invest in these properties or in these businesses personally. So he'll have personal money coming out. Because the partnership has debt and has debt basis and will be taking depreciation, we want that individual to own that, what we're going to call a co-invest or a pari passu, right? An additional investment in that opco and the operating partnership. We want them to hold that themselves, right? So a lot of times there'll be a disregarded entity that you'll see here, and it'll be like the GP LLC or whatever, additional interest here. So they will invest in that business, in that partnership, in their personal name. We do not want your investment in a partnership that will generate losses with debt in an S corp. We just have undone the whole reason for you having this as a partnership in an S corp. So don't hold your interest in that partnership inside of that S corp. Hold it personally. This is the trifecta of it. I'm sharing a picture here. You'll be able to see it and watch it. You can also sign up for my newsletter. I do a much deeper dive of this. You can go to plug-newsletter.com. But this is the ideal structure. Right now, number one thing to do when you're DIYing your own taxes is don't mess it up. Don't put big assets into an S corp. You can make a change later, but when you start putting big assets into an S corp, this is the biggest thing I see with DIY owners. They just set up a corp, they make an S election, or they set up an LLC and make an S selection, and they just pretend everything will be fine, and they assume someone will be able to unpack it when they finally get around to it, and that's not the case. Right? So if you have to start somewhere DIY, start with a partnership. Start with a disregarded entity. We can add on complexity later, right? So don't assume you have to have this right out the gate. And you may not need this. You may be an asset-light business and all you need is an S corp. Very, very possible. Same thing, don't make that S selection right away, right? Create a disregarded entity, run it like that, get professional tax advice. But this is the most popular structure I see. When I'm drawing this is usually where I end up for a decent-sized business. And there's a lot of cleanup that we've done in the past. There's a lot of bad advice going out there. So make sure you look at this. Make sure you subscribe to my newsletter. We'll keep these videos coming, and I hope you really enjoyed it.